Hi, everybody. Today we have Alan Chen, CP on the channel. So last time he had a lot of questions, and I know to get CP advice, I have to pay like thousands of dollars to get advice like this. So I'm giving it to you guys for free, as well as having Alan on the channel. So thank you for your time, Alan. Okay, before we start, Alan has basically e-commerce accounting course for e-commerce business owners. So tax and accounting, basically how to reduce tax and solve your accounting stuff. So you have 50% off. I'll put somewhere on the link description in the video here, so you guys can check it out. I think it's limited to 50 units. So use the code OXG-50. Okay. So Alan, we're having, I think, a Q&A session, right? So we have compiled a few questions from the group already. Okay. So you just want to give a very, very brief background about yourself, then we'll start with the questions.
Yeah, sure. Hey, Jonathan, thanks for having me on your channel again. I realized you told me last time you got a bunch of DMs and inboxes from co-op questions, right? So yeah, that's why I'm that's why I'm back on again. But yeah, anyway, if those of you guys don't know me, my name is Alan Chen. I'm a certified public accountant here in the United States. I'm located in Los Angeles, and basically my agency Free Cash Flow is focused on one niche and one niche only, just online and e-com business owners. So we offer an all-in package to basically help them with any kind of sales tax planning, federal tax planning, state bookkeeping, helping with evaluation, forecasting, and really everything in between you can think of. And we basically offer a really personalized package just to provide for just this niche.
Yep. Okay, Ken. So thanks for the introduction, Alan. Let's start. Okay, so first question is, this guy, I'm 19 this year. This guy made over 200K this month. Okay. So I'm guessing he solved sales and marketing and managed to scale. Okay, his question is, how do I not get audited or sued by the IRS if I run like a dropshipping store? Or like when does the IRS start knocking on his door? Is a major concern here. Yep.
Well, first of all, congratulations, whoever answered that question. 200K a month is amazing. That means already a 7-figure guy, right? Annually. I think there's like multiple ways to answer this question. First, you're of course definitely going to be taxed if you're making 200K a month. So I would definitely start reporting it. I know a lot of people are very afraid of tax and tax situation, so they try to avoid it as long as possible. Please don't do that, especially if you're making 6 figures a month. But that doesn't mean you have to pay more than you have to, right? So if you are making 200K a month, you're potentially looking at maybe 2 million a year. I would say anything over 500K, I would definitely start reaching out to a licensed accounting professional, especially one that's in your field of that you're doing. So if you're running an e-com store, I'll find someone that's really specialized in e-com accounting to look at your books and look at how much sales you're making and look at what great tax deduction they can get you. It's definitely worth the money, I would say. And also, if you're 19, I will also be a little bit careful because given that you're so young, the IRS may look at as a factor of, are you making this in a legit way, right? Because you're so young. Are you doing drugs? How do you make 200K? Like most people cannot make 200K a year, right? So for a guy to make 200K a month, it does raise some flags. So that is another reason maybe that you want to partner with someone to look through your books, make sure you are reporting the right numbers to the IRS and not making any mistakes or adding an extra zero that you're actually making 2 million a month. So nothing like that, right? So I would definitely try to reach out for help if that was this person.
Okay. Next question is, how much money should I set aside per year to pay for taxes? So I'm guessing for example, like e-com is very capital intensive, need a lot of cash to buy inventory, for example, right? But you still need to pay taxes. So how much do we set aside?
Yeah, I would say there's no magic number of like how much you need to set aside for taxes. It really depends on each person's situation, for sure. I know it's a very vague answer. You're looking for something specific, right, Jonathan? But it really is the truth, because I would say like some people, they start an online business, but maybe they have a spouse that works a W-2 job, right? That would really commingle and changes a lot of the tax thresholds that they may face with. And then some people may be running an online business and maybe have some like other stuff that they have going on, right? They may do a lot of stock trading or cryptocurrency or things like that, right? And those things will also impact how much money you need to keep for your tax savings. But I would say in generally, if you just want like a rule of thumb, I would keep 20% of your bottom line for a tax saving. So say you're making like $1 million a year, right? I would say you would want to keep around 150,000. It might be too much actually. Normally, I'll say that's too much. Let's call it 10%. If we're looking at just top line, if you can keep 10% of your top line as like a tax reserve, I think you'll be in good shape.
And this is cash sitting in the bank, correct?
Yeah. I mean, because I do want to caution, as you do make more and more money, like 7 to 8 figures, things start getting more complicated, right? Because you're also subject to a lot of sales tax issues. And sales tax means, those are the tax collected by each state that you cross the threshold for the nexus. So in case you guys didn't catch my last video, so nexus is basically any kind of affiliation you have with a certain state. And now in the world of online business, that can mean what they call economic nexus, which means you just have enough of a concentration of customers in the state you're selling to that would trigger sales tax responsibilities. So for example, if you add up all your sales to the state of, I don't know, Florida, right? And it's over $100,000. The state of Florida expecting you to pay sales tax to them to their rate, which is around 7-8%. So that's why I'm saying don't only look at your federal and state and think that's it. That's all my obligations. Make sure you include sales tax in that. And if you include sales tax in that, I would say 10% is a pretty good figure.
Okay. Okay. Next question is, why is tax planning important? Why should I care? Usually it's, people deal with it on the deadline, or how do I actually go about planning for the year, basically?
Yeah. So tax planning is a question we get very frequently here at FCF. And we get a lot of people on the calls and they're very confused. They're like, why is it important? Don't I just fill out some forms and put some numbers down and that's it? That's how much I pay? No, that's actually the absolute worst way to approach tax paying. That's like I'll say the what they call like the procrastinator's way, right? It's like, oh no, it's April 14. I'm just gonna put something down. That's how you really ensure you're paying the most tax. I say, like, if you're an individual person, you may not, the margin of how much you have to pay for tax may not be as big, right? But if you own a business, and if you own a 6, especially 7 or 8 figure business, that number really, really astronomically grows. Really, meaning the gap between someone that does good tax planning and someone that does it last minute, that could be like $50,000 to $70,000. Like literally, like that's like money back in your pocket, possibly if you do good tax planning. So why is it so important? Well, it's a lot more profit for you at the end of the day. You can think of it as another a revenue source, really, right? Think about it, another $50,000 to reinvest in your business, to buy that yacht that you wanted. So there's so many different ways that you can use that money, right? So I think a lot of the misconception comes from the whole April 15 date, right? People think, oh, April 15, only time I have to pay taxes. But that's not true. Really, the true tax planning, if you think about it, happens during the last year, right? That's actually the year you're paying the taxes. So if you think about this year, April 15, well, this year is a little bit different with COVID. May 17, 2021, because the COVID deadline, right? But really, you're looking at your 2020 taxes. You're looking at January through December 2020 for how much tax obligations you guys have. So you really should be doing tax planning during that year. And there's a lot of things you can do, especially for growing businesses that's still on cash basis accounting. So there's a lot of things where, you can do things like, I'm just give you a few examples. Okay, Jonathan, you can do what you do. You can prepay for inventory, which means you just buy more inventory that you're going to use next year, but you make sure you buy in the year 2020. That could be an extra deduction right there. You can prepay for software license, right? If you're going to use some kind of email marketing software or some kind of post-sale software like Reconvert, right? .io. You can prepay for it for a year, like an annual subscription, save some money because you're paying annually, and get that as a deduction the year of, say 2020, right? So you can just buy that December 2020. If you're running an agency, what you can do is you have the flexibility of invoicing your customer later, right? So like for you, Jonathan, if you want, you can invoice your clients later, right? So you can invoice them January 2021 to not recognize that revenue for the year 2020. Then you wouldn't have to put that as your top line, right? So if you have a client that's going to pay you, I don't know, $20,000 a month, you'd be like, oh, I don't want to recognize that revenue and pay taxes on it. Let me worry about it in 2021. You can do that. Those are little strategies you can use, especially your cash basis taxpayer around year end, to really kind of like work around and manipulate the numbers a little bit. And it's a very legal thing to do, being a cash basis. It's nothing illegal I'm talking about. Very legal.
Okay, so you normally sit down with the client, say, look at all your expenses, and then basically plan ahead. Okay, we're going to do this, and then just do it, right? Is that the only thing, or is there anything else in terms of planning wise?
Oh, if you're really talking about planning, there's tons of things, right? Because if a typical person or typical accountant or generalist that you say just look at a tax form and just say, hey, give me your numbers, give me what you think your expenses are, and you just put it down. There's tons of things you're missing out on. Like there's lines like business meal, business travel. There's COVID credits that last year that was given out. That's you're not gonna find any tax form. That you're just not gonna think about or plan around because an accountant didn't tell you about it, your CPA didn't tell you about it, right? And those things will be too late to think about by the time April 15 hit. Like April 14, you can't take those credit if you didn't eat the business meal, if you didn't do the business traveling, right? If you didn't think about what credits you can possibly get yourself, it's too late at that point. You should have done it during that year. And those are the things that, since we're more of a, I would say, an outsourced CFO service for our clients, we're there for them every step of the way. We tell them month after month, hey, this is what you need to do to make sure that by the time you file your taxes, you're going to be one of the guys that's going to get your maximized tax savings back versus someone who just, hands their stuff over to an accountant around April 10 and say, hey, do it. And then times, okay, pay this much. Like, oh, really? It's like, okay, I guess I have to. Some accountant told me, Okay. So it is a huge difference between good tax planning and just doing it last minute.
Okay. Next question is, so you see the numbers across industry, right? You see the numbers at the bottom line across industry. What pitfalls should e-commerce business owners look for when scaling the e-commerce business? Especially, I'm pretty sure multi-7-figure plus 8 figures. What's the pitfalls they should look for?
Yeah, if you're talking about pitfall on the accounting side, there's gonna be a couple, right? One is definitely not knowing your numbers, right? I think that's in general, that's gonna be a cover all. A lot of time, I see these super successful e-com owners. They're at 7 figures. They're at almost maybe 8 figures, right? And they don't have bookkeeping. They literally just keep their number on Excel, and there's nothing wrong with Excel, but they keep it like randomly, like a number here, a number there, right? Like just not organized, not in any kind of financial statement. And I'm just like really like flabbergasted. Like, how do you keep track? How do you know how much money you made at the end of the day? And they say, I make enough. I get a lot of answers like that. I make enough. Meaning like, I make more than I'm losing. So that's good enough. And if that's good enough for you, that's good. I can't argue with that. If you think you make enough to cover your living expense and that's all you wanted, good for you, man. But for some of the guys, they're a little bit more, I would say, aggressive, or, they really ambitious and want to go after a certain future for themselves, for their family, for their brand, right? For those guys, I really encourage them to know their numbers very well. Know their margins very well, right? Know what the winners and losers in their business if they're running an e-com business, right? Like a lot of time they just look at gross margin as a whole. And that's even great. Like some of our clients don't even do that. They look at a client and they're like, okay, I'm at 60% gross margin. Seems good, right? But what we do is we take a step further, especially if you're running multiple products, we break it down to each product's gross margin and to see which are the winners, which are the losers. And we're like, do you really need to keep these losers around that's actually dragging down your profit margin? Right? If you don't, you should get rid of them. You should only focus on your winners and scale harder on your winners, right? Scale harder on the things that's giving you higher margin, right? So that's one point we want to make. The other thing is, one important, I would say, metric that I see a lot of people don't look at is they should actually look at cost of goods sold plus ad spend as one unified metric. Because a lot of time, if they just look at cost of goods sold, they look pretty good, right? Yeah. And then they realize they suck at running ads. And they actually need someone like Jonathan to run their ads. And they're like, then they're like, I need to fix this because my ROAS is actually terrible. And then they look at the margin, it's only around 10% or maybe even less than 10%. And and then they're like, oh, what's going on? And then they realize the full story is they actually need to be better optimized on their ad side. So those are the two, I would say, main costs they have to control: your cost of your inventory and your cost of your ad spend that you're going every month, to see if you're actually making a true real profit at the end of the day.
Okay, but even if you are looking at COGS plus ad spend, right? If you're in the growth company stage, you're expected to acquire customers basically at break even, right? Because you're trying to acquire customers. So is that okay? Or it's just different businesses, then you just have different metrics to kind of look at? Does that make sense?
It makes sense. I think it really depends on what your plan is, right? I think though the e-com owners that come to us and say, hey, I'm purposely doing this to break even because I want to acquire
Grow
just
faster.
a big enough customer pool, because what I'm trying to do is actually do email marketing, for example, right? And I'm like, well, you have a game plan that I'm not going to argue against it. I'm just making sure you have enough, burn rate, you have enough cash flow to get you to that point. Sometimes you have this great grand plan of, yeah, I'm doing this, but then I'm like, yo, you're bleeding cash. Do you know that? Do you know that you're gonna run out at this point in this many months, right? So we're more in an advisory role. We're not running your business, obviously. We're just looking at your numbers historically and also try to forecast for the future, right? Like if you're telling us your number up to the month of, say, May is this much, and this is how much you're running each month and how much you need for operating cash each month, we're going to tell you, okay, we're going to predict the rest of the year for you and say, can you get to that point to meet your goal, right? So if we think yes, we'll tell you that. We think no, we're like, okay, you might need to change your plan because you're bleeding too fast. So those are things that are very important. We never want a client to think they have this great plan going, but then at the end go cash negative, and don't actually complete it.
Okay. Next question. What compliance and accounting problems will you run at 100K per year versus like $1 million per year versus like 8 figures per year? So obviously, the more money you make, the more problems you have. But what's the issues that most people face?
Yeah, I think one big thing I mentioned is it's definitely the sales tax piece. As you get higher and higher, like if you're at 6 figures, I don't think you have much to worry about because most states threshold starts at $100,000, right? If you're US based, but when you hit 7 figures, when you hit 8 figures, those marks, you really got to start looking at, in a certain state or cluster of states, how many of those you're actually hitting that threshold, where you're going to have to do sales tax registration for those states and then do sales tax returns for the states. So that can get pretty messy. Common thing is they think that they only have to look at the state sales tax rate, but they have to look further than that. They have to look at the county rate, they have to look at the district rate, and they have to look at the city rate and add it all together, combined with the state rate to get what they actually need to pay for each customer that they're serving in that state. So yeah, I would say as they get higher and higher, definitely get someone or get one of the software solutions out there if they must, to really do their sales tax compliance well, because they will start getting trouble in a lot of states, and they're going to get a lot of these letters very fast these days because because online business is booming right now, right? And all these states realize that, so they're like, we need to collect our revenue from these guys, and they're doing that. And especially if you're not running on Amazon, if you're running on the Shopify side, I think Amazon does have a way of like withholding for you a little bit, but Shopify, it's completely your responsibility, guys. Shopify does not help you out with that at all. So if you don't do that, that's gonna be on you to handle the IRS and figure out how to handle the tax notices and liens. Okay, but like sales tax threshold, give a bit of background, and like if there are 50 states, like how the heck does anybody like measure or control like the 50 states? There's so many things to worry about. How does any eCom owner like figure it out? Like there are 50 states. Like it can't be tracking for every single state, right? Well, yeah, technically it's only 45 states collect sales tax, but yes, I understand what you're trying to say. Yes, it's a lot. I wouldn't do it myself. I would use software solution. There are software solutions out there. I can recommend some. I think TaxJar is one of them. Avalara is another good solution. They're more automation solutions, right? So they will calculate it for you. I would still try to get a licensed professional to check those numbers, even if you do use an automated system to run them, just to make sure that you're not overpaying them, right? And there's certain strategies also that I would say software will not catch for you. And if you had a CPA working for you, year long, or you have an in-house person working for you, they will be able to better like warn you about. So for example, like I mentioned a lot of time, the threshold is 100K for a lot of states, right? But say you like if you had a competent CPA who's been working with you throughout the year, and by Q3 or by November of the year, you're around 90,000 of sales for the state. Let's just keep using Florida as an example, right? If you're 90,000 Florida, and I'm telling you, hey, if you hit 100,000, you're gonna have to register and pay for sales tax in that state. I'll ask the business owner, do you want to do that? And I'm gonna tell you what the impact is, right? Maybe you had to pay like $8,000. If that's the case, right? I'm like, is that $8,000 worth you hitting 100,000, or is it worth you just excluding Florida in your paid ads and just focus on the other 49 states? Does that make sense? And that's an $8,000 saving right there for this year. Because as long as you don't cross that threshold, you don't have to pay. You could be at 99,999, and technically you don't have to pay sales tax to that state. But if you just use software, they're not going to catch that ahead of time. They just be like, oh, oops, you had 103,000. You just crossed over by 3,000. You're gonna have to pay this year. You see the difference? But if there's someone that's working for you and helping you along the way, they can warn you for things like that.
Okay. How do people like learn about sales tax and how it works so that they don't get burned, basically?
I mean, there's of course a lot of online resources. If they would just want to like Google it, they can just search, certain state sales tax rate if they wanted to. Just to self plug the course that Jonathan mentioned at the beginning of the time. I have a entire module on sales tax, so it's pretty comprehensive and would help a lot of business owners understand that.
Okay. Okay. So what will happen if you actually don't file for sales tax or federal income tax?
So it's interesting, right? So if you don't file sales tax, the federal government won't come after you. It's just the individual states that come after you. Now, some states are more active than others. Some states they have the money and the resource to go after the eCom owners, so they do. They go after you with full force. So California will be one of them. If you don't want to piss off California, okay. Yeah. So, but certain states are a little bit smaller and they don't have so much money. So, maybe you can afford to wait a little bit on them. But I mean, in general speaking, if you don't pay sales tax to a state, what they can do is they'll put penalties on you. They'll charge you interest, right? And I mean, it doesn't seem like a big deal, but I know some states charge up to like 25% of your income as interest. It's like as a penalty. Yeah, it's crazy. It's crazy. So, and I mean, the worst thing I've seen a state can do to you is obviously ban you from selling in that state. I don't actually know. I've never seen it happen, but it's just written on their website. It's like they're on the state website saying they can ban you from selling. But I don't know how they prevent that given that you're selling online. But I wouldn't try it. I wouldn't test it out, right? On the federal side, so on federal government, the bad news is technically there is no time limit as when they can come after you if you don't file your taxes. Okay. So if you don't file at all, right? It's not even just don't pay. You don't even file your taxes. Let them know that you have taxes you have to pay. Yeah. They have no statute of limitation when they come after you. Once you file and you just don't pay, right? Like you just don't pay the taxes. They have 10 years to come after you for tax fraud, tax evasion, unpaid taxes. I think don't quote me on this, but I think the rate right now is 3% plus the the government's bond rate or the market rate, the free market rate as the interest. And don't forget this, it's compounded daily for any unpaid tax amount. So I would just say like you almost want to like overpay at sometimes. Just like if you have a 9-to-5 job, sometimes you do overpay, right? Like you have a withholding and then you overpay. But what they do is just refund you, right, at the end of the year. So I always say business owners if you don't know how much you got to pay, just pay a little bit extra. And then when you do file a tax at the end of the year, they'll give it back to you. The government's not going to steal your money other than keep it to make some interest for themselves, but they'll eventually give you the difference back, right?
Okay. Next question. This guy is from an international seller. So he's asking, hey, Alan, I'm not American. I want to sell to the US market. I want to make sure I'm covered on the accounting side. Other than FEIN, tracking economic nexus in each state, and registering for sales tax, is there anything else that I should look out for?
Yeah, so I would say if you're not American and you're trying to sell in the US market, I actually recommend all of our international clients to set up an LLC in the US market for a couple of reasons, right? One, it brings legitimacy and trust to your business. So it just makes it a lot easier for you to, talk with partners or banks or anyone that you want to associate your business with, right? So that's one reason why you want LLC. Two is exchange rate, right? Exchange rate is horrible. If anyone had to deal with exchanging USD to any other currency, right? They take like 3 to 5%. I heard even worse rates sometimes, 5 to 10% sometimes, depending on what country you're dealing with. So that eats into your profit heavily. So being able to keep, like, especially if you have a large concentration of US customers, which a lot of people I'm sure listening do, you want to keep the money you earn in USD and then spend the USD, right, for your expenses, therefore avoiding the 3 to 5 to 10% of transaction rate fee. And the third reason is, once you do establish enough of credit and trust in the US, you can open a bank account and open a credit card with that, right? And the credit card's point system is amazing in the US. They give 3 to 4x ad spend points back to you. So that's like first class flights and luxury hotels for your business, right? But as far as other things you got to do. If you do want to establish an LLC, there are certain compliance forms that you got to fill out. One of them is called 5472. This is basically a form that you fill out to basically establish that you are a foreign entity that operates in the US and that you have some sort of treaty in the US between your home country and the US. Therefore, that you don't have to pay US taxes because you're just going to be paying taxes in your home country. So this prevents you having any US obligation, which is great. And it'll just make you pay US taxes. And even further better is if you happen to be from a country, say, I don't know, Singapore or Hong Kong, and those countries are territorial tax system, which means they only tax on income you earn within the borders of that country. So income you made inside Singapore. There could be a way where you really don't pay taxes on neither side, right? I'm not saying this is going to apply to every situation out there. So this is a huge warning out here. Not every situation going to have this, but there are certain situations where your US source income might not get taxed in a lot of like both jurisdictions. So there's a lot of ways maybe you get a lot of tax savings out of that way. But yeah, I would just say I would set up an LLC just to establish yourself, have that legitimacy, and then to figure out from there.
Okay, understood. Okay, next question. I guess simple one. What's the difference between S corp, LLC, and C corp? Which one should I choose?
Oh, okay. Yeah. So a business entity questions that we get often also. I would definitely say if you're just starting out, go with LLC. It's the simplest thing to set up. There's even a lot of sites that just helps people set up LLCs now. And they make it so much simpler than you going through the state website and doing it yourself. Of course, that's possible too. You just want to save a little bit of money. The reason you want LLC is the preferred method is because, one is simple paperwork. And two is, if you don't set up any business entity, you're sole proprietor. But then that doesn't offer you any kind of protection, right? People set up an LLC because it's a limited liability company. That's what it stands for. And it offers you personal liability protection, meaning that if someone sues you, they can't come after your personal asset. They can't take your home. They can't take your car. They can only take up to your business assets, right? What's in your business account, business bank account, and a business asset. We have inventory, for example. And then beyond that, I guess, why would you want to go with the other two, right? S corp or C corp. So C corp is definitely the most complicated. C corp is what you think of when you think of Facebook, Amazon, Google, the big companies of the world, right? The Fortune 500 companies. And the reason they're C corp is for a couple of reasons. Is one is they want that kind of, I would say, ultimate company status, because having a C corp puts you in the cost eyes of a lot of regulations, a lot of accounting regulations, a lot of federal regulations. And even though it's a lot of work and complexity, what it also brings you on the pro side is it brings you a lot of trust for your business, right? Knowing that so many people are scrutinizing, looking at business, you're doing the whole financial audits for your business. So your numbers are very looked after, right? They trust it. That's one reason why you will have one C corp. The second reason is just raising capital, honestly. If you're a company that have grown big enough where you're looking to have JV money, right? For any kind of investors.
Sorry, what's JV?
Oh, like any kind of joint ventures or any kind of venture capitalist money, like VC money, anything like that. You will want to be a C corp, because those companies are going to be like, okay, I need you to be a C corp because I want you to go do a financial audit and be legit, and I can trust your numbers, right?
Okay.
Because when you're a C corp, there's a lot more paperwork you got to do. You got to set up a board. You got to have a president, a vice president, a secretary. You got to do minutes. You got to do board meetings. There's a lot of rules. But the advantage is you're the most trusted company form, right? The other thing, the only other reason not always say only, but there's a couple of reasons. Another reason would be, right now in the US, C corp technically do have the lowest tax rate forever, due to what President Trump did with his tax act that he introduced. C corp corporate tax rate has lowered from 35% to 21%, which is the lowest the US has seen for 4 or 5 decades at least. So that would be one reason, but it like I said, it's still go back to complexity, right? Because technically, when you're running a C corp, you run into what they call double taxation. You get taxed at the corporate level, so the 21%. But then if you take any money out of the company as a owner or shareholder of that company, you get taxed again at your personal tax rate, which can range from 10 to 38%. So that's double taxation. There's ways around it. You can just take a salary, for example, and just take no dividend payments, just ways around it. But generally, you do get the double tax as an issue. But there is cases where you just keep money inside the company, right? But then there's still more complications because there's also ways where the U.S. government has caught on and said you can only keep this much in the corporation and the rest you have to distribute out, or you face penalties. And okay, now we talk about the last one, which is S corp, right? The S corp is kind of the in between an LLC and a C corp. It's what they call the hybrid corporate structure, right? Mm-hmm. And the reason they call it hybrid structure is it is not as complicated as a C corp. Like the amount of work you have to do to set up is not as much, but it's also not as simple as an LLC, right? So you get kind of the best of both worlds in that you still have a corporation, but you don't have to go through all the paperwork and all the structural things you have to set up. And then the most important reason why eCom owners or even agency owners want to do an S corp is the avoidance of self-employment tax. So I'm not sure if you guys know, right? So if as like a self-employed person in the US, you have to pay what they call self-employment tax. And what you have to pay basically an employee portion and the employer portion. And each side is around 7.65%. So if you add it both together, they're about like 15, let's call it 15%, right? So that's like 15% of self-employment tax on your income that you're bringing in. Pretty big, significant, right? But as a S corp, you basically can act as an employee of your own company, and you will cut that in half. You save 7% of your income. So if you just think about it, if you say you're making 100,000, say you're making $1 million, what does that mean to you, right? What does 7% mean to you? And you can do the math from there. And so a lot of time, it's worth it for a company that has a net profit of more than 100,000 to do that, because they can take that net profit and pay themselves a salary out of it, a reasonable salary. And whatever salary they pay themselves, that amount is the only amount that's subject to the self-employment tax, while the remainder will not be subject to that amount. But then you kind of need a professional to tell you what's a reasonable salary. You can't just declare yourself. You can't just say yourself, hey, I think I'm worth only $2,000, or I think I'm worth $80,000. You need someone to measure that and give you the market value of what you're worth to your company that you're working for.
Okay, so why would an eCom owner? Follow up the next question. The business structure to pay the lowest amount of tax, right? Would an eCom owner consider going from an LLC to a C corp? Like, how does that?
An LLC to a C corp?
Yeah, to pay the lowest amount.
I guess it you can say technically yes. I would say technically yes, because like I said, right now the flat rate is 21%, right? But like I mentioned, there's two factors against that. One is the fact of it's going to be a lot harder for you to take out money from the company, because you either got to pay yourself a salary or you got to do a dividend, right? But neither way, if you pay yourself a salary or dividend, that money becomes your personal income. You get taxed again on it. It's just different rates, right? Dividend gets taxed a little bit lower rate because it's considered capital gains, but then salary gets taxed your normal personal income rate, which, like I said, is 10 to 38%. So that's one reason why you wouldn't do that. Right? Because then you have to really, hire, a good amount of accountants and CPAs to help you figure out just the right amount to take out and just the right amount to keep in. So I would say the headache is usually outweighs the tax savings. But if you have grown to an amount, I would say like 50 million or more, then yes, I would say at that point, you kind of want to opt for the C corp, because when you're at that point, you're looking at growing to a large number of employees. You're looking at probably bringing in outside investor money, right? So then they're going to request that. They're going to ask you to switch to a C corp at that point. But for most eCom owners, that's, I would say in the 5-10 million or less range, I would not do it, just because of the complication and the extra headache for the eCom owners to deal with the C corp. Yeah. But it's kind of your mileage will vary, depending on that. But there may be other factors that may push you to a C corp. There are a lot of possible exit strategies that you're looking at. That may be a reason why you want to go C corp.
Okay. Next question. Hi, Alan. Wondering how to handle sales tax in other states. It looks like most states want us to collect sales tax, but do we register our business in every state?
Okay. Yeah, great question. Whoever submitted that. You don't have to do it ahead of time. Let's just say that, right? So say you're already selling to 50 states. That doesn't mean you have to right away register all 50 states to sell in them. No, that doesn't mean that. It's again, we go back to the threshold rule, right? It's only when you cross that threshold is when you have to register for that state. So I know we've been keep using Florida, so we'll keep it consistent. So Florida, say they have a 100,000. Usually it's two parts actually. It's 100,000 with like 200 transactions, right? It's like one or the other that you meet. You have to register for sales tax. So if you do hit that number, and those are the figures that for Florida, then yes. So say you made $100,000 of sales to Florida customers this year. That's when you file, right? So say California is 500,000. Say you hit 510,000 in California. That's when you file. So don't do it beforehand. It doesn't benefit you, I would say, because once you register, they're expecting you to start collecting from your customers.
Okay, Ken. Next question: what will an accountant do with? Will he help with tax and registration process? The tax and I think you get it.
Yeah,
will he help
sure.
with the tax and registration process? Yeah.
I mean, that depends on the accounting service. Some accountants offer very limited scope services, right? It's like some just focus on bookkeeping, some just focus on tax, some just focus on consulting. I mean, here, like we at Free Cashflow, we kind of take all three pieces and kind of package together because we don't want our clients to like have to look for three different accountants and then have all three accountants talk to each other and work out a deal of like, okay, this is what we think the client should do. We kind of just say, hey, we wanted to eliminate all that headache for them, and we'll just figure out all three issues for them. So like for us, yes, we help with registration, we help with the sales tax process, and help you with the bookkeeping too. So all three pieces.
Okay. Ken, next question. Hi, Alan. I run multiple dropshipping e-com stores, one general store, a few niche, and some branded as well. How should you advise me? Should I put it all into a single LLC, or how do I structure, I guess, corporate structure wise?
Yeah. That's an awesome question. Whoever submitted that, they're thinking way ahead of the game. So I would definitely advise against single LLC setups, especially if they have multiple successful brands, right? So say they have like 2 or 3 big brands, right? Like a I don't know, a pet brand or a beauty brand, a nutritional brand, right? These 3 categories are totally separate, right? Like they don't relate to each other at all. So I would, if I was them, I would set up a separate LLC for all 3 different brands. And the reason is very simple. It's diversifying your risks. If you think about it, if for some reason your pet brand, you make a pet bed and for some reason the pet died sleeping on your pet bed, I don't know, because the material is something they're allergic to, right? And then that customer sues you. You don't want them to be able to come after all 3 of your companies, right? You want them to only be able to bring down your pet bed company, God forbid kind of thing. They bring down your whole company, right? So, but then your other 2 company lives on. Your beauty brand, your nutritional brand, they're fine, right? But if you have commingle all 3 businesses into one LLC, then technically the court that you go into with a judge can deem that this is actually just one business, one business entity, and they can go after all of it, right? So they say they have a big settlement or a big ask. They asking for like 20 million. They can go after all your business assets at that point. So that's why I would, with how inexpensive setting up LLC is, I would definitely advise separate out LLCs. Don't just group it all in one. Okay,
but if you're separate LLC, you need additional accountants, additional accounts, and everything, right? It's basically additional costs, duplicate. Right.
Yes, that's why. Okay. That's why I only advise if you're running multiple successful stores.
Okay.
Right?
Okay.
So say you're running only one successful store and you're just testing the other stores, right? And they're making like 200 a month, 200 a month. Of course, it's not worth that your time to separate out and like you said, have separate bookkeeping. Maybe incur higher accounting fees for that, right? It's only when you're running when you know that these businesses have taken off, right? They're 6-7 figure ones. That's when you have more to lose when you say a lot more to lose in those cases. So I think at that point, it's worth the accounting fees or whatever it is you got to pay someone to separate it out with LLC fees.
Okay. Ken, next question. Do I charge taxes to everyone based on the country they are purchasing in? And if so, how do you manage or organize tax payment information to ensure you're paying taxes to the proper government bodies? Or does Shopify auto submit that for you? Confused at how to set up taxes? Help. Yeah, long question.
Oh, okay. So it's a lengthy question, but I'll try to take it from the beginning.
I guess,
no, it's okay. I think I got it. So one is, does Shopify help you with this? The answer is no.
Okay.
They don't submit or remit or tell you how much you have to pay in sales tax to any state. Okay, just Just got to get that out of your mind. So Shopify does not help you. Do not expect Shopify to help you. That's one. And then the second thing was, do you only charge taxes on good purchase in your country that your business resides in? I'm assuming that person is international that's asking this question. Yeah. So that's why it's a little bit hard to answer, right? So I guess if the international person is selling in the US, I think I can answer that part of the question for them. Meaning that if they're selling in the US, it's the same rules that applies. It's the economic nexus rule. Meaning that if they have sold to a large amount of customers in a certain state, then yes, technically they would be obligated to pay sales tax to that state. Now, how easy is it to go after that person who's international and non-resident? That's a whole like great area of questions. I'm not going to go into that, but yes, and technically in the eyes of the law, as long as you're selling to a person and that the shipping address is to a certain state, that's how they count what sales tax you have to collect for that state, if that makes sense, right? And as far as I guess I know he's trying to ask for other countries. That unfortunately I can't answer. Like if he ships to Europe, how does he deal with that? I think you have to pay VAT. I don't want to answer that too closely, so I'm not a European accountant.
Okay, Ken. Next question. Alan, give me the hacks. Okay, give me like not well-known tax deductions that I can use right away to file my taxes this year.
As a what? As eCom owner, as agency owner, as
eCom.
eCom. Okay. Yeah, I mean, there's a lot we can talk about. Obviously, I mean, I'm just gonna roll through them because I don't know who knows what, right? Because a lot of information out there. So started off, I think it would be like startup cost deduction will be one that's really nice. Like if you guys are just starting out in the world of eCom, this is one you probably want to take right away to help you reduce your taxes a little bit for the year. And startup cost is basically like the name mentioned, it's the cost of starting up your business, right? So it's any kind of product research you've done before you start your business. It's any kind of incorporation, like filing fees, like cost of setting up your LLC, anything like that is basically startup costs, right? Like what's the cost of starting up your business? And those are the things you can take up to $5,000 your first year as a tax deduction right away. So that'll help a lot of you like just starting out. So if you guys starting out, that's a great one to start with. Another thing to look at is, of course, make sure you capture your business meals, right? I think a lot of time people don't realize this, but if you're a full-time business owner, a lot of time, the technical, I guess, wording for business meal is that you have to be doing business with someone. Okay, so okay. I want to make sure that people are clear. Okay. So technically, if you're just sitting in a room like me and Jonathan's doing, when we're not actually talking to anyone else, it doesn't, and we're eating a meal, it doesn't count. Okay, technically that doesn't count. But given that we're doing online business, how like there's so many occasions where you're actually talking to someone, right? Think about it. If you're doing customer service, you're talking to someone. If you're talking to a supplier on Skype from China, you're talking to someone. So there's like so many occasions where you are conducting business because you're online business, right? Because I think when iOS wrote this rule, they're assuming you're like an office job, where you actually have to travel somewhere to talk to a supplier or logistic. But people running online business, technically you're conducting business just by sitting on your laptop, right? So don't forget about business meals, because a lot of time, unless you're literally just sitting by yourself and not looking at your laptop and just sitting at a desk and not doing business, that wouldn't qualify. But I would say 80% of the time you can find a way where business meal will qualify as a business deduction. So you should take advantage of that, right? And another one is, of course, business travel. If as COVID is lifted right now and you guys start doing more traveling, any kind of business related travel you can deduct, right? And that includes the airfare, lodging, and luggage fees, and even gratuity that you paid that will count, and laundry that you do during your trip will count, and kind of a bunch of other miscellaneous things. But the point is, if you're starting doing traveling, even if you're going to attend a conference, right, like a eCom conference, or if you're just traveling to China to visit your supplier, any kind of trips like that, you should try to get a full deduction for any kind of those costs. And then beyond that, you should also look at your home office deduction, right? Most of you are now working from home because of COVID, or because you're just a digital nomad and you don't need an office. So the IRS is actually very generous with their home office deduction. Home office deduction is basically as long as you have an exclusive space in your home that's only serving your business purpose, right? So it can't be for anything else. It has both, basically a living room would be a bad place to put an office, because living room technically also for recreation, right? But say you have a room dedicated to your business, you can take a deduction for how much of that room you use for your business, right? So there's two ways to calculate it. There's a simplified way and a more, I'll say, complicated accountant way of doing it. I would definitely look at both, but I'll let you guys know the simplified way, because in case you guys are doing your own taxes. The simplified way is super easy. The simplified way is you just look at how many square footage you're using for your business, up to 300 square foot, and you multiply it by the IRS rate of $5, right? So say you're taking up the whole 300 square foot of an office for your business. You just do $300. 300 square foot times $5 equals $1,500. There you go. That's your tax deduction, $1,500. Now that's good and all, but let me introduce you to the other more complicated way, okay? And why if you hire a good accountant, they'll look at both. The more complicated way is called the actual expense deduction. The actual expense deduction says we're actually going to take a percentage of the usage of your home as a deduction, and we're going to take it across many of the expense categories, right? So let's take a concrete example. Say you have a 1,500 square feet home, right? And you're using 500 square feet of that. So we'll do 500 divided by 1,500. That's 33%, which means you can take 33% of your utilities, so electric, gas, water. You can take 33% of your rent, 33% of your mortgage, and 30% any repair and maintenance you do. So you repair the roof of your home this year, you can take 33% of that. And if you just repaired, your actual home office that you're using, that's actually 100% deduction, because that's a direct deduction, because that's only for your home office. So if you think about all this side of the category, we have gotten our client up to like $20,000 to $25,000 back in a tax deduction. And that's a huge difference when you think about the other side's limits of $1,500, So that's why you really want to do your comparison, really want to be knowledgeable about your tax deductions and not get gypped, right? Because if you think about it, if you just do your taxes, file it, and you don't know about this side, that's another $20,000 you could potentially be missing out on.
Okay, question from me. If I buy like Kitkat or biscuits, is that deductible?
Kitkat or biscuits?
Yeah,
I guess if you treat it as a business meal, if that's your lunch,
what about snacks in office? Does that count?
Snacks in office, if you have an office, yes, it counts. But I think you'll need to have employees.
Okay, got it.
Yeah,
can.
Yeah. If you're paying for snacks for your employees, or you're throwing them a party, it counts too. So you can be very generous. If you have employees and throw them a party, 100%.
Even if it's pantry, like kitchen pantry.
Yeah, pantry snacks. Yep.
Okay, yep. Got it.
But you just need employees. It's not for yourself.
Okay, can.
Yeah.
Next question. When should I start worrying about accounting?
When should I start worrying about counting? 6-figure mark is probably I would say the time, right? You hit 6-figure mark, you should start either studying up yourself by educating yourself on accounting laws and taxes, or reach out to a professional and get some consultation. Okay.
Next question. How much cash should I allocate towards deposits in the bank, sitting in the bank, towards my product, towards wages, buying, inventory, and any advice on managing cash flow?
Okay, this is a very general question, right? Because it's really product, even eCom, right? It really depends on what product line you have, right? Like a fashion brand, a nutritional brand is very different, right? And a one that's selling washer tablets is very different than someone selling like big equipment, right? So I don't know if there's a general rule to doing it, but what you can do is you can do analysis on your numbers to figure out the right answer, right? You can do cash flow analysis. You can do burn rate evaluations to determine kind of like a 12 to 18 month trending of your business based on historical, to see that, this is how much cash I burn every month. This is how much my operating expenses every month for the last 12 months. And then you use that to kind of predict the future, right? If you're saying your revenue level is going to stay consistent like this year or last year, then you're like, okay, this is how much cash I'm going to need this year also. If you're saying your revenue is going to take a 30% bump this year, then you also need to bump up your cash flow by 30%. You just bump up your probably 30% of your operating expense by 30%. So that's kind of a way for you to estimate and forecast going forward. So then that this is how much cash I need to keep in the business for tax and operating. And this is how much cash I can use to, either reinvest in other product lines or reinvest in myself.
Okay. Cash versus accrual accounting for e-commerce businesses. What should we use?
Starting out, when you can, I would say you definitely want to start out as cash basis. It's just easier to understand, right? Cash goes out, That is expense, cash comes in, it's revenue. Super easy, right? Accrue method brings a lot more complication. It makes it a lot harder to understand because it doesn't follow cash. It follows what they call like usage, right? The actual usage of the expense or actual recognition of the revenue is what they do. So a little bit more complicated, but I would say as long as they don't make you switch to accrual, which is usually around the $5 million mark for tax reasons and $1 million for bookkeeping sometimes. So as long as you don't, I guess 7-figure, I guess would be the right number, right? 7 figures is when you start kind of guys be like, oh man, do I need to switch to accrual? What can I keep cash, right? You usually don't want to switch to accrual until you have to. To make you switch. So cash, there's just more flexibility. Like I kind of mentioned the other question, there's a lot of ways you can manipulate how you do it, right? Like you can, like I mentioned, you can prepay your inventory, prepay your software license, or delay your revenue invoices, right? And if you switch your accrue method, all those things are out the window.
Okay. Next question. This is a bit biased, but how to choose an e-commerce accountant for my store, for my e-commerce business? Basically, how to choose an accountant.
How to choose an e-com. Okay. I mean, there's a lot of ways you can choose the right e-com accountant for your store. But obviously, if you're looking for e-com accountant already, you're already on the right track, right? You're already looking for someone that only focus on e-com, thus e-com accountant, right? Okay, I'll say there's a couple rules. First, make sure your e-com accountant is a CPA. That's very important. The CPA is kind of the highest certified level you can reach as an accountant in the US, right? So you know that person is both neither rich in education and experience, right? That's one. And obviously you want to hire an e-commerce accountant that understands your business from top to bottom, right? Hire someone that speaks your lingo and you don't have to explain anything to him. One of the biggest frustrations I hear from clients is like, oh my God, my accountant doesn't understand anything I'm saying. When I tell them about ad spend, when I tell them about ROAS, they don't know what I'm talking about. You know, when I'm telling them about my Facebook account that banned it, like what account? What account got banned? So don't hire someone like that doesn't understand. Just test them, right? Test them on lingo. Number 3 is hire an e-com account that already has clients in your specific niche. Let me let you know what that point. So say you're a fashion brand, right? And you are interviewing accountants right now. Say, hey, why should I hire you? If that accountant's answer to you is because I have 2 other fashion niches already, that's a really good sign. Why? They understand you. You don't have to explain anything to them. Any part of your P&L, the profit and loss statement, any part of your balance sheet, they understand already. They know what kind of inventory you should have. They know what kind of margin you should be meeting. You know, they know what makes you profitable. Then they can answer questions like the last one, how much cash you keep in your books, right? That's how why it's so important. Number 4, hire a US e-com account if at all possible, even if it costs a little bit more. Let me explain why, okay? Okay, so I know there's a lot of options right now for accountants, right? You can hire one on Fiverr even. You can Google one. You can hire one on Upwork even, right? And a lot of time, of course, the international ones are going to be cheaper, right? Just like anything else. I'm sure a lot of you guys use the VAs and stuff. Well, accounting is one of those subjects where you may not want to do that because of how sensitive it is, right? Just think about it. Once you're trusting a CPA, you're providing them with your all your financial data, right? Your bank information, your credit card information. Do you really want to give that to an international person that you can't track down and don't know? Probably not, right? You kind of want someone that has a registered US business located in the US that you can easily locate and find, right? That has a US license number, a CPA number. So then it's you know that person's legit and you know that person's going to follow all the rules of the US courthouse and US laws that make sure that they stay in line and go with their fiduciary duty to never reveal any of your client information because they have a duty to not do that, right? So that's why it's so important. And of course, number 5, I would say, you know, you want to hire an e-com account that's going to be supporting you all year round and can kind of be your outsourced CFO. Let me know what let me tell you why that's important. Like if you haven't taken away anything from this video, is that I'd hope you take away that you kind of want an accountant that's just not there to do your taxes and just put some numbers on the paper for you. That's not what you're after. You know, if you're really trying to scale and really trying to get tax savings, you're looking for someone that's actually cognizant and really looking out for you every step of the way and doing tax planning for you month in and month out, doing the monthly bookkeeping for you month in, month out, making sure everything's allocated in the right place, in the right expense allocation code, making sure that they understand your business in and out, tell you your margins, tell you when your margins are falling, and let you know when, you know, you can plan for an exit even, right? That's why it's so important to have a comprehensive accountant that's kind of around for you all year long, because they can help you solve so many more problems than just tax issues. I think that's what people don't realize out there. But yeah, those kind of my top 5, I'd say, criteria, if you will, to look out for an eCom account.
Okay, and to follow up that question, so what type of questions should we be asking this accountant if we're interviewing him, and obviously not from an accounting background?
You usually ask them questions about your industry, right? Hey, do you understand how e-com business and nutrition? Do you understand what the margin for that is? You should ask him questions like, do you have clients in my specific niche? You should ask him for his CPA number, right? You should ask him where he's located, right? Is it in the US or somewhere else? Is it in a very shady country? We could, of course, ask him if he's a CPA, just in general, right? And I think though you can ask those questions and they don't stumble, that's already a super good start. If they're already like, I don't know, I can't give you that, then next, X out, X out your call.
Okay, Ken. Next question. How do you settle payroll? I usually pay my VAs through PayPal and other stuff, but if I want to hire full-time staff, for example, how do I settle payroll? What software do you recommend? Why? Also, what are the advantages of the softwares that you recommend?
I think there's a lot of payroll provider solution out there. I know. Personally, I don't like. We use QuickBook Online a lot, right? And QuickBook for Intuit has their own payroll solution, right? But if I'm gonna be honest, my most recommended one is gonna be Gusto. The reason why is Gusto is kind of built just for startups or like businesses, like online businesses. They're very, I would say, reasonably priced. They price per head, per like head count. So then you're not gonna get overcharged. And then they're just really easy to set up. They just walk you through it. The interface is very intuitive, and they take care of all your payroll forms that you need to fill out, right?
Okay.
So it's also very easy for your accountant to kind of like get in sync with them. They have a portal just for accountants. So then even if you don't want to do it yourself, your accountants can just go in and run your payroll for you on your behalf. So it's just very intuitive. They kind of like plan ahead knowing that this is the niche they want to serve, which is online businesses.
Okay. And Gusto is spelled how do you spell it?
Gusto, but I can include a link below if you needed to.
Sure. Yeah. Can. Okay. Next one. Can I deduct my taxes when I buy inventory for my e-commerce business?
Yes, absolutely. Absolutely. But it's not how you think about it. You can deduct it once you use the inventory, right? So it's not when you purchase it, it's when you use up the inventory. Does that make sense?
Use up means what? Like when you sell it?
Cost of goods sold.
When you sell it, basically.
Yeah, when you sell it. Exactly.
Okay. So when you're buying from the supplier, you can't deduct?
Yeah. So when you actually selling the inventory is when you can write down your income to a lower taxable income number, right? So I guess it's you think of it 2 ways, right? When you actually buying the inventory, you're actually paying cash for it out the door.
Yep.
So if you're a cash basis, technically yes, you can take a deduction for it, but you got to kind of see, do you want to? Is it correct to take it at that point in time? A lot of time, you may be, I would say, you may not even have that much income to absorb that inventory deduction you're taking. So it may be that you put you in a situation where you don't want to take that deduction. You may want to wait until you sell that inventory to take it. But there are situations where you're just like, screw it, I just want to take all the deduction the year off. You can do that, but then you might set yourself a little bit bad for the next year, right? Because you're buying ahead of next year's inventory. So the next year you don't get that deduction. Does that make sense?
Less tax being paid now is better than less tax next year, right? You're enjoying.
Yeah, if you're looking at like present time of money, sure. Yeah.
I am. Okay.
Yeah, if you are, yes. Yeah.
Okay, got it. Next one. What's the difference between a software like A2X and QBO? So QBO, I think, stands for QuickBooks Online. Yeah.
A2X, I'm not super familiar with, but I know they're more of a newer company, and they basically offer a way for you to sync your Shopify data, if I'm not mistaken, directly with their platform. Well, QuickBooks Online is not that intuitive, right? You kind of have to just do it you just have to enter it manually almost yourself. And you kind of need more outside help to do that usually, right? You need to hire like a bookkeeper or someone like that. A2X, I think, is built for Shopify owners in a way. I think it's like more of like concentrated situation, a solution for them.
Yep.
I haven't used it myself, but I heard good things about them.
Okay. Ken, what key metrics should I look at in my e-commerce business? So just now you mentioned gross margin, but is there anything else that this guy should look at?
Yeah. So like I mentioned, you don't want to look at just gross margin. You kind of want to look at gross margin plus the ad spend portion of it, right?
Anything else
to get
besides those two?
the true numbers. I mean, there are the key metrics. You do also want to look at your burn rate. Burn rate is very important. Burn rate basically measures how many months you have to go before your business runs out of money. Just straight up.
But assuming they're profitable. Assuming they're profitable already.
Assuming they're profitable. Okay. Assuming they're profitable, then you probably just want to look at free cash flow, right? Okay. Free cash flow measures how much cash you have, that don't get absorbed into any operating expense of your business, right? It's the money you have that's outstanding that you can do other things with. So you can think of it as money that you don't want just sitting there, right? Like in a savings account somewhere. You kind of want to know that this is the amount that you can safely use to either, invest in real estate or stocks and bonds, or just reinvest into your business line, right? And double down on another product line. So that's a very important metric to have.
Okay. Next question. If I'm not American, but run a USA LLC, do I still have to pay US sales tax?
That depends on nexus status. Very much so. So there's two sides of nexus. There's physical nexus, and then there's also economic nexus, right? Physical nexus basically measures any kind of physical attachment you have to a state in the US, right? So think of it as you have a warehouse in the US, a fulfillment center. If you have any kind of agent on the ground, right? Any kind of employee, any kind of a person that works for you in the US, right? If you have any kind of like affiliate program where there's you have a network of people that recommend your business in the US, right? Those are all physical nexus possibles, right? Economic nexus is you have a strong enough concentration of customers in the state. So 100,000 is what the number we keep hitting, right? But say you're eCom owner, an international eCom seller that just started out, don't worry, right? You're only selling to $10,000 in the state of Nevada. You don't pay anything. You're only selling 20,000 to the state of California. You're good.
Okay. Ken,
yep.
Next question. What are the top 5 mistakes that Shopify sellers like myself, what should we look out for in tax and accounting?
Number 1 is not doing your quarterly estimated tax. So like it goes back to that misconception that tax is an annual event, right? But actually businesses are required to submit quarterly taxes. So every 3 months, you're supposed to submit tax to the government. Number 2 is not looking at your transaction fees. Transaction fees are a huge killer, right? And then you really need to know how much you're paying in transaction fees. And that really adds up in accounting, and it's a tax deduction. So don't forget about that. And number 3 is not having good enough bookkeeping to track your margins and your actual profit, right? A lot of time, like I mentioned, owners just have information scattered everywhere, or just look at top line Shopify screenshot data saying, "Oh man, I made 8 figures." That's not your real profit. That's not your real profit. You got to look at your whole picture. And number 4 is not understanding cash flow, right? Not understanding that how much money you actually have access in your business to do more things with it than just have it lying around, in a savings account. And number 5 is, of course, not maximizing your tax deductions. There's so many different ways of doing this. Like I mentioned, there's so many ways of educating yourself on tax deduction and credits. So if you are not doing that right now, I highly encourage you to start learning about them.
Okay. Next question. What is your recommended accounting software? I think it's QBO, and why?
Yeah, definitely QBO, because that's our preferred software. 3 reasons is scalability, automation, and multi-business support. Scalability means that the software grows with your business, right? It at a certain limit, it does have certain limitations at the higher end, but I would say for most e-com owners, it's more than enough as you scale to 7-figure marks. Number 2 is, of course, automation, because QBO is so I would say used by so many people. It has a lot of great automation syncing, where it syncs with most credit card providers. It syncs with most bank accounts. So a lot of automatic fees goes into. So there's not a lot of manual entries you have to do. Where we use a lesser known software, they may not have like a specific bank that you're using, right? And then 3 is just multi-business support, meaning that, it handles all type of businesses, right? Not just eCom. If you run an agency, it handles that. If you run a SaaS business, it handles that. So it handles all kind of business. So if you pivot to something else, it can also do it. You don't have to switch accounting software. It can handle all of it.
Okay. Next question. Do you use any software like taxjar.com, quaderno.io, taxdo.com, Avalara to automate sales tax calculations and do your filing? And what do these softwares do compared to QBO? So I'm guessing this guy's shopping around. He wants to know your opinion and yeah.
Yeah. So the 2 I heard of, or who I've seen people use the most, is definitely TaxJar and Avalara on that list. They're the 2 most popular, and from the feedback we got, are the most easy to use. In our agency side, we don't use those software. We prefer to use our own proprietary method of calculating sales tax. So we don't rely on the software to do it.
Okay. Next question. How do you record all your expenses in Shopify? Is it automatic, or do I have to manually pull the data from Shopify into Excel?
Bro, nothing is automatic in Shopify. Shopify is technically, it's very terrible for like taxes and accounting and bookkeeping. Honestly, it is. Okay. And I think there's some solutions as far as Shopify app software that I've seen that does okay job, that makes it better, but it's not perfect. There's no perfect solutions there that I found. Shopify is also not the best source of truth. If anything, you want to rely on your PSP, your payment service providers, meaning like PayPal or Stripe, to be your source of truth of how much money you're making. So don't rely on the Shopify numbers. And then if you talk about record all your expenses in Shopify, I'm guessing you mean like your app fees and your Shopify payment. I mean, those, yes, you can rely on. I mean, you just have to take the number out of Shopify and put it in some kind of accounting software, I would say.
Okay. Next question. I paid like $60K in taxes last year, and I feel like I'm getting ripped off. Okay. How do I legally pay less tax, Alan, without obviously breaking the law?
Yeah. Yeah, that's great. Don't break the law. It's a great question. There's a lot of ways to do it. Number 1, I would suggest if you're paying 60,000 taxes, that must mean you're not taking advantage of retirement planning plans that's available to you, right? We haven't had a chance to talk about this, Jonathan, but so say you're a solo owner of your eCom business, right? Or solo owner of an agency. If you're a US citizen, happen to be, right? What you can take advantage of is what they call a solo 401k plan. Solo 401k is very powerful. If you guys haven't heard of it, I would say you start paying attention to this part and Googling it if you want to, right? Solo 401k is basically a 401k plan. I'm sure if you're US, you heard of a 401k plan, right? It's a retirement plan issued by the government. And usually as an employee, you get around, I think this year's $19,500 as a tax deduction. And you put that $19,500 into a retirement account for your future, right? And it acts as both aspects, both as a tax deduction and as a future planning tool for your retirement. But as a business owner, you get the solo 401k as long as you're a single business owner or a spouse. A spouse is fine, where you don't get $19,500. You get this, $58,000 as a tax deduction. So think about it. He's paying $60,000. That's almost fully covered. $58,000 as tax deduction. It basically, because you get 2 parts. You get the employee part, which is the $19,500, and then you get another around 30. I can't do the math in my head right now. It's very late. Around $38,000 to get to that 58,000. Basically, as long as you make enough income in your business, you can get the full 38,000, and it caps at 58,000. But get this: if you have a spouse that also works in your business, that number's doubles. So you get $116,000 as a tax deduction if you take advantage of. So that's not no small number. I'm not kidding, right? This guy's paying 60,000. So that's 116 right there. If he has a wife, I don't know this person, right? So that's one big one you can take advantage of. You should look into if you qualify. Obviously, I'm just talking very general terms, but usually if you're a solo business owner, you do. Even if you don't, there's other tax planning things, but this is the biggest if you just happen to be solo. And I know a lot of people out there are solo, right? Obviously, another one is you should just make sure you capture all your business meals. Make sure you capture all your mileage if you travel by car. Make sure you travel all your flights if you're flying this year. If you're, like I said, if you're cash basis, there's a lot of way to move things ahead, move expenses ahead, right? To pay less taxes, like we've been mentioning, like prepaying for software license, buying additional inventory. And then, if you run an agency business, I'm not sure what kind of business guy runs, he can, also move revenue to next year, bill his clients later to help out in those cases.
Okay. Next question. I have 3 VAs working for me now. How do I expense the cost of hiring my VAs?
Normal business expense. It'll be under some sort of consulting fee because they're not actual employees of your company, right? Especially if you're international VAs, you don't even have to send them a 1099 or anything like that. So it's just like a service fee, really.
Okay. Next question I'm interested in. I'm looking to exit and sell my e-commerce business. How do I value the business and how can I maximize the value? What is a fair valuation multiple? I'm running an e-commerce store, physical product.
Oh, okay. I see. So you're looking about like, how do I value my business?
Yes.
Right?
So this guy wants to sell it. How does he get the highest payday, basically?
Got it. I would say step one is definitely, I would say, you need to have very clean bookkeeping, and not just bookkeeping, probably like investor level financials, where it's the difference between, I would say, bookkeeping and investor level financials is the highest grade of financial you can obtain from, a certified public accountant or someone that understands how to perform that, because they cover not just the basic bookkeeping needs, they cover all the margin needs, right? All the operating ratio needs that I would say someone who's looking at your business and looking to buy will want to know, right? Because it doesn't include just your current state. It includes a 12 to 18 month forecast of what your numbers going to look like in the future. So the investor can kind of feel comfortable saying, okay, if I buy this business, what is my return on it in the next 18 months, right? And you're already showing them that, right? So then that already gives them the confidence that you're worth, 3 times multiple, 4 times multiple, right? And of course, other things you can do in the meantime to help you is of course, make sure your margins are very healthy, right? Make sure that when they're running their margin analysis on your business, that your gross margin is high, at least above 60%. And then when you add in ad spend, you're still running at a good rate, 15 to 20%. Your net income, is at a good rate, right? It's not like you have too much business. I would say for eCom, you at least want to look at 10 to 15% usually. You just want to have like very healthy looking ratios across the board, right? You want to make sure that if your your inventory turnover looks very healthy. You don't have a lot of dead inventory just sitting on your books, right? They're gonna make sure that you can turn over your inventory very fast. That's gonna be a sign of a very healthy business, especially if you're running eCom.
Okay, and what's the valuation? I know 3 to 4 is normal, right, for eCom. Yeah, what are you seeing from your agency side, your clients?
Yeah, so if it's I would say a branded business and not drop shipping, obviously, a drop shipping gets very terrible ratio. Yeah. I would say 3 to 5 is pretty typical. Yeah. Okay. If they're running the business well, they have good margins, and they're having someone watch out for that. Yeah, 3 to 5 is good. Yeah.
And this is based on revenue or EBITDA?
It depends. Depends who's buying your business, right? Some people are just buying your business to flip.
Yep.
And in those cases, they're gonna look at like a revenue. But if they're actually looking to run your business, like just like continue running it, they will look at EBITDA.
Okay. Next question. What type of deal structures can I explore when I sell my e-com business? So you have your experience in M&A and stuff. So yeah.
I mean, there's different ways of doing it, but obviously the most simple way is just all cash, right? You just pay straight cash for the business is the easiest way. But then there's other ways of looking at it. Usually, what they call an earn-out, right? An earn-out is basically that the buyer pays a percentage in cash plus a profitability of your business as a partnership, right? Mm-hmm. So in this case, the seller receives payment from the buyer as the business continues to grow, right? That's usually a way of doing it. And there are also other methods where, if your business is big enough where you have like, I don't know, stock to offer someone else, like shares of your company, you can also just do a all share exchange of your business where you actually kind of like invest in each other's business in a way, and in exchange, and there's no cash changes hands, right? If you're more of not of a cash poor business. To me, I would actually recommend you probably do some sort of cash plus earnout method, because then you kind of get the upfront cash benefit, but then you also get the earnout benefit of it, right? As the business starts to grow, you still get a portion of it.
Okay. Next question. I'm looking to exit and sell my ecom business. Same thing. Are there any specific things that I should be looking out for on the accounting side before I go and sell?
Yeah. I think this is very similar to the other question, but basically you just want to keep very healthy margins, right? You want to keep good margins. You want to keep good cash flow. You want someone to do your certified, you want someone to do great, clean bookkeeping for you, so then you can pass any kind of due diligence, right? That's one of, I would say, the biggest fallacies, or a way for a deal to not complete, right? Not go through, is they look at your bookkeeping and they say, wow, this is terrible. It's jumble. It doesn't make sense. Like, I would never buy a business that has this kind of numbers. Or if they ask you about it and you can't prove it out, they're like, okay, can you prove out that this is how much revenue you make? Can you prove out this how much expense you have? And you don't have an answer for that. That's usually a really bad sign for any kind of investor.